But once the psychology shifts, then begins to run to gold. And once the run to gold starts, if it's significant enough, there's hardly anything that can stop it.
For a limited time, the Austrian Mint and SD Bullion are offering you a Silver Philharmonic buy 19, get one free coin deal. Officially issued by this storied 825-year-old European bullion mint. These famous European silver bullion products come packaged complete in protective sealed Austrian Mint tubes containing 20 coins apiece, or in bulk sealed Austrian Mint cases containing 500 troy ounces in each. These guaranteed 1 troy ounce Austrian Philharmonics are official European legal tender silver coins. Each is comprised with a minimum 0.999 fine silver bullion content. Austrian Philharmonic bullion coins qualify for silver IRAs, making them an excellent choice for tax-deferred, long-term bullion savings. Discreetly shipped, fully insured to SD Bullion customers' doors and non-bank vaults. Don't delay. This free silver Austrian Philharmonic bullion coin deal will end soon.
This is Elijah Johnson with SilverDoctors.com, and back with us today, our good friend David Morgan, one of the top silver experts. David, thank you so much for joining us today.
Elijah, it's always great to be with you.
All right. Now, the first topic I'd like to discuss is the global economy, because you recently reported on this on your YouTube channel. You talked about how we're really, it seems like, in the worst shape since 2009 for the global economy. This is, different articles were talking about this, Business Insider, for example. So what are some of the indicators that you're seeing that really show this to be true?
Yeah, just for everyone's benefit, I do a podcast. It's called The Weekly Perspective. Every week I wrap up what I think is the most important financial news and end with something in the precious metals. I try to keep it around 10 minutes. And during that last one, as you were referencing, the auto sector has really fallen off a cliff. And BMW, one of the stalwarts of the high-end auto sector, has definitely taken a hit, not making earnings. So there's all kinds of pockets like that are indicating that this idea that, America is back on track and we're growing and all that really isn't true. The global economy, as I've been saying for months now, is shrinking. We're in what I call stagflation, which means that we have a contracting, slowing global physical economy, yet prices continue to increase. And this is kind of the worst of all worlds because of what I just said. People can't stretch that dollar far enough, and yet there's less and less economic activity.
Definitely. Now, with respect to the United States economy, one of the things that is signaling possibly a recession down the road is the inverted yield curve. Now, a lot of people have been talking about this. It's the inversion of the 3-month Treasury and the 10-year Treasury. Can you explain for our viewers why this usually signals a recession, and if you think this is signaling a recession right now?
Well, it's a fact that it signals a recession, so there's really no debate on that. It's like you could debate of how long ahead it's the perfect signal. In other words, does the recession start 6 months after this inverted yield curve? Does it have to be this big an inversion? And, petty things like that. But no, there'll be a recession. As far as what does it mean? I mean, it's the old adage, and I think people are really interested in topics should Google or Bing or search engine to borrow short and lend long, which means that we're lending money at a given interest rate for a great length of time, like the 30-year bond, and then borrow short, meaning that you need ready cash now and you're willing to pay a price to borrow that cash. So an inverted curve means that you're willing to pay more for short-term cash as far as the yield. So for a quick example, I'm just making up numbers to provide the illustration. So if you're getting, 4%, let's say, on a long-term commitment, but you got to borrow 5% short-term, you're in big trouble. And this has happened time and time again in these systems, these fiat systems. And so there we are again. We've lent long, borrowed short, and this causes very big problems. This is what happened in the last great run-up in gold, as you saw inflation around 13% officially, and the measures were pretty accurate in those days. And it was very, very interesting that you could get higher yield on a short commitment, like a 1 year, a T-bill for 3 months, 6 months, 1 year, than you could for a longer duration. So what happens is it distorts the economy and things slow down. And then hopefully when the economy slows, then the yield comes back to normal conditions, which means the long end of the yield curve, the 30-year, 10-year, are at a higher yield than the short-term rates. But once there's a run to this situation, meaning the trust in the system begins to break down, and it's been doing that for quite some time, really since 2008 financial crisis, eventually the confidence in what's the most trusted, which right now is the U.S. dollar, that trust begins to break down. And once that takes place, it's a psychological event. It's nothing you can put on a chart. It's nothing you can really time. But once the psychology shifts, then begins the run to gold. And once the run to gold starts, if it's significant enough, there's hardly anything that can stop it. Now, having lived through that once, Elijah, I'd just like to take another moment to state that once that run to gold began in 79 going into 1980, yours truly being, let's say, overstudied or overeducated and not having the experience that I have now, I actually thought that was it. I mean, once that run to gold accelerated and, gold was on the financial news like 3, 4, 5, 6 times a day, and we're getting these massive moves up in gold and silver, I really, being, as I say, overstudied on hyperinflations and destructions of currency systems and everything that I knew at the time intellectually or academically, I thought it was over. But I said, it's hard to stop. But Volcker came in with the guts, let's say, to say, I'm going to stop this, and threw interest rates up at a unbelievably heard of high place, in the 20% range, which absolutely quelled the markets. And when he did that, believed that that's it. This is the end. This is the destruction of the currency, because not only does a high interest rate show you a high yield, which means a great return if you're putting your money into savings, but it also shows the risk of the investment. In other words, you want to get a high yield if it's extremely risky, which means if you look at it from that perspective, this is an extremely risky investment called the U.S. dollar. And you know what? I was wrong. It was. Based on the yield, turned out to be the best thing you could have done. In fact, I had some friends in the gold market with me at the time, and one of them cashed out pretty near the top and put all of his gains into treasuries and really reaped great rewards. The best trade you could have made back then was to sell everything that you had and move into the long bond, get that 17% and hold on to that thing for 30 years. That was the best move. That, all things go up and down and it's cyclical, and that's the place not to be now. You want to really be looking to short-term yields only and preservation of wealth, which means a portion of your money in the precious metals.
And what is your perspective on the stock market? Because if we look at, for example, the Dow, we see that since the beginning of the year, last year was the worst year for the Dow since the Great Recession. And now going forward here, though, we've seen actually quite a run up since the beginning of the year, but this last month or so has not been that great. It's even gone down slightly. So what is your perspective where the stock market stands right now?
Yeah, I'm going to do it basis the Dow. I usually like to use the S&P 500, but I've got the Dow chart in front of me. So you can look at it. This is how I look at it. You're asking me? Here's how I see it. I see a double top basically around the 26,000, 27,000 level. Then we had this huge down wave on massive volume, which is not good. In other words, there's a lot of people that want out of the market. And we got down below 22,000 basis the Dow. And then we got a V bottom and it shot right back up to about 26,000. Now we're in an indecision pattern and we're getting lower highs. We're basically touching the 50-day moving average and we're still above the 200-day moving average. But I see weakness. I see indecision to lower. I know a lot of my peers think that the Dow is going to, the stock market generally is going to go higher and higher. I don't rule it out, but the only thing that would convince me that it's going higher is a break via the Dow. I'm now looking at the S&P of 27,000. Once it got above that and the volume looks strong, I would be convinced we're going higher. Right now, no, I don't see it that way. I see it going lower. Once we break through the 50-day moving average and test the 200-day average, if it doesn't hold, that, if you're technically oriented, is probably the place to, if you have stock positions, you want to protect them or get out, lighten up your positions or whatever, because nothing grows to the moon. I don't like the chart pattern. I don't like the fundamentals. I mean, the fundamental fact that we're doing on this discussion, and I know I'm repeating, but it bears repeating, and that is the overall global economy, U.S. included, is on the wane. It is contracting. It is not expanding. There are many problems throughout the sector, not just in housing and the auto sector. There's credit card debt. There's student loans. There's job issues. There's all kinds of things that are obviously in our face that say, look, it's a time to save money, not spend money. It's a time to reevaluate what your investment portfolio looks like.
Now, getting to precious metal markets, we're seeing that ever since the right before the beginning of March, we saw this big pullback. We're starting to see a rise again. Where do precious metals stand right now, kind of in the midst of all this economic uncertainty? Well,
it's a hedge. I mean, basically, 10% is good for most people. And if you're a big believer that, people like me are wrong, you should just take 10%, buy it, don't margin it, and relax. And then if in the case that perhaps I am right within, your lifetime or my lifetime, you're hedged. That's kind of the attitude I think most people should take. And go ahead and invest away in whatever you want, real estate, the stock market, bonds, whatever. But there are certain points in history where there is a run to gold. And it's because the faith in everything else has basically gone away. Faith in government to control things has gone away. And there's a massive readjustment in the paper price of gold to reflect all the malinvestment and distortions that have been perpetrated upon the economy by the powers that be. I think we're facing that again. I really do. But you don't have to buy into my scenario. You can evaluate that for yourself. So copper's looking pretty good, but it's kind of touching the 50-day, 200-day moving average. So it's sort of being a bit wishy-washy, meaning, is there any growth ahead? And as I've said earlier, no, I don't think there is. Gold is moving up over the 1,300 level and testing it a couple times. I think we might have to test it a couple more times. I don't see this massive pullback in gold that some of my peers do. I could be wrong. I told my people on the premium paid people, just a week ago, I believe, that 1280 is a level. I'm wrong. The market will say it, and the market will tell you if we get below 1280 on gold, we close below 1280 3 days in a row, then that's the time to really buy puts on your positions or sell down or whatever. I don't see that happening, but that doesn't mean it can't happen. Again, I've always stated the market's smarter than anyone. So I'm still long. I'm strong. I am building cash. I've got select positions. Almost everything we've got in the portfolio right now is performing quite well, even in a market that's not all that strong. When you consider what's going on in the, let's say, in the stock market overall, gold's actually held up fairly well. And we have a massive cup and handle formation in gold. The handle's pretty ugly. But once we get above the 1350, 60 level, we've broken through the handle, and we've really got a lot of upside room. I do think we will get to that level this year. I'm one of the ones that thinks we'll probably see 1400 sometime during the year. I don't expect it to be imminent. I think it'll be, past the summer doldrums, but I do think in the latter half of this year we'll probably see some stronger gold buying and higher gold prices.
Definitely, and one of the key resistance points it seems like is 1350 or 60. If we do see it, as you're saying, go above that to 1400, where's the next level that? It doesn't seem like, looking at the chart, it seems like I don't see that much of resistance to like, let's say 1600 or something. So I guess, but what is your perspective?
No, that's right. Yeah, you're right. I mean, there's not. And so once you get above that level on volume, then the algorithms will come in, the momentum players, the floor traders, or aren't the floor traders anymore, but you'll see a move up. There's not much resistance, as you just said. So, does that mean, David said from 1400 it's going to go to 1600 really quickly? It could. Will it? Market knows. But I do know from a factual perspective that it shouldn't take as long. Once the momentum builds above that level, you'll see more and more interest in the markets. A lot that goes on in the financial markets are basically done by computer algorithms, and they're pretty well written in most cases. So when there's low resistance, the market or let's say the quants take advantage of that fact. And it's just a fact, what you just stated, and what I'm just reiterating.
Definitely. And you mentioned about how, if people don't see that much of risk ahead in the economy, 10% is still a prudent allocation. But it's interesting because I don't know, but I don't think people really have 10%. Most investors have 10% in their portfolio of precious metals, do they?
Oh, no. That's the pathetic thing. I mean, there's an old adage I got from the great late, I should say late, he's still alive, but Jim Dines. I mean, and I don't know if it's his quote. It's probably not. He probably took it from somebody else. But it's once the ship has sunk, everyone knows how it might have been saved. I mean, there'll be a lot of gold bugs post-crisis. However this reset happens, the banks close, they don't close, I don't know. I don't want to be a big doom and gloomer. I'm a realist. The thing about it is that these things have happened before. It's a repeating cycle. It may be different as far as how it actually unfolds this time, but the overall theme, meaning that there are distortions in the economy and the economy has to adjust, that story goes on over and over. And if I might just give myself another plug here, if you go to themorganreport.com, you should be reading the blog every other day. I usually don't blog every day, but usually 3 times a week. That's something to look at. And the other thing, I think there's a button that says About. If you go to the About, you'll see my handsome face in a picture. That's not what I want you to do. Just below that, there is access to the film, The Four Horsemen. And that is an hour and a half worth your time to understand how cyclical these boom and bust cycles are throughout the economy. These have been going on for a very long time. And it'll actually, in my perspective, give you a good view of not being panicked about this, kind of taking it in stride, realizing it's part of the greater cycles. And I think it puts things into perspective, because I know that some people that are new to this arena tend to look at only, let's say, the dark side or the what ifs and get a picture that they imagine is pretty bleak, when the reality is it could be. I mean, in some cases it may be bleak, but not as bleak, I think, as some people imagine it to be. So if you watch a film like The Four Horsemen, it'll put things into perspective where you realize that all things ebb and flow. There's a fall, winter, spring, and summer to everybody's life, and basically the same thing in an economic situation. And most of us go through the 4 seasons once at least during our lifetime. So I'm trying to keep it real, but also in perspective that it's not something to really fear. The more aware you are of it, and the more prepared you are mentally to have a good attitude, regardless of whether the economy is expanding or contracting, is basically on you. But you can do that by having good education. To just sit there and hear one person speak about it, or 2 or 3, and then imagine how bad it's going to get, that's a waste of time and energy. You really want to be better educated than that.
All right. Well, David Morgan, thank you so much for your time today. Before we let you go, did you want to share with the viewers, it's themorganreport.com, so yeah, where they can find you and any last thoughts you had?
No, just I want to plug the podcast. I mean, if you just go to iTunes, put in The Morgan Report, you'll find it. If you're on Android, I'm not sure, but probably just search for The Morgan Report. And it's, it's a public service to everybody. Try to keep it short and sweet so that you're tuned up as far as, from my perspective, on what's really important to know about the financial markets.
All right. Once again, David, thank you so much for your time.
My pleasure. Thank you.